On Friday night, the financial world was shaken by a dramatic announcement from President Donald Trump. In a Truth Social post, he declared that the United States would impose a 100% tariff on all Chinese imports starting November 1st, 2025. Within hours, markets around the world tumbled, wiping billions off stock valuations and sparking fears of a renewed trade war between the world's two largest economies. The chaos, however, didn't come from just one post. Trump actually issued two separate Truth Social statements on the same day. The first was released while markets were still open, triggering an immediate sell-off as investors tried to interpret his remarks. But after the markets closed, he followed up with an even longer and more definitive post confirming that the tariffs would apply to all Chinese imports without exception. The announcement marks one of the boldest economic moves of Trump's second term, and one that could reshape global trade in the months ahead. Trump's post accused China of taking an extraordinarily aggressive position on trade. He claimed Beijing had circulated letters to several countries signalling that it planned to impose export controls on rare earth materials and other critical goods. These materials are vital for industries such as electric vehicles, semiconductors, and renewable energy. In response to China's move to impose export controls on rare earths, Trump said that he will be forced to financially counter their move. He confirmed that the United States would apply a 100% tariff on top of existing tariffs, which already range between 30% and 40% for many Chinese goods. He also mentioned potential export controls on critical US software. The timing of the announcement, made while US markets were still open, intensified the shock. The S&P 500 sank 2.7% on Friday, in its worst day since April. The Dow Jones Industrial Average dropped 1.9%, and the Nasdaq Composite lost 3.6%. Stocks have been on track for a slight gain in the morning until Trump said he's considering a massive increase of tariffs on Chinese imports. Stocks may have been primed for a drop after surging to records recently in a nearly relentless rally. On Friday, the S&P 500 fell 182.60 points, or 2.7%, to 6,552.51. The Dow Jones Industrial Average fell 878.82 points, or 1.9%, to 45,479.60. The Nasdaq Composite fell 820.20 points, or 3.6%, to 22,204.43. The Russell 2000 index of smaller companies fell 74.25 points, or 3%, to 2,394.59. Financial media outlets described a scene of chaos as traders dumped tech and manufacturing stocks. Shares of companies heavily reliant on Chinese components, such as Apple, Tesla, and major chip makers, saw steep declines. The sell-off quickly spread to Asia and Europe, with many indices across Tokyo, Hong Kong, and Frankfurt opening sharply lower. Economists say the panic stems from uncertainty over how China will respond and what the new tariffs mean for inflation, trade, and corporate profits. Before this escalation, US tariffs on Chinese goods averaged between 30% and 40%. Adding another 100% would effectively more than double the cost of imported Chinese goods, from smartphones and electronics to clothing, machinery, and household items. US goods imports from China in 2024 totaled $438.7 billion, making it America's largest source of imports. If prices on those imports were to rise by 100%, it would translate to hundreds of billions in extra costs for American businesses and consumers. Those higher costs would likely push up inflation, just as the Federal Reserve has been attempting to lower interest rates to stimulate a slowing economy. Analysts warn that if inflation rises again, the Fed may have to delay or even reverse its plans for rate cuts, potentially slowing growth and hurting job creation. Trump's reference to rare earth elements isn't new, but it's crucial. These 17 minerals are essential for advanced technologies, from smartphones and batteries to fighter jets. China dominates global processing of these materials, controlling over 70% of global production. In recent months, Beijing introduced new rules restricting exports of certain rare earths and gallium-based products, citing national security concerns. Western analysts believe the move was aimed at reinforcing China's position in the global tech supply chain. Trump's tariffs, in turn, are widely seen as a counterstrike meant to break that dependency. However, experts warn that this could lead to supply shortages worldwide. The US has been investing in domestic mining and refining projects, but these efforts are still years away from being able to replace China's role. Here's what you need to know about rare earths. What are rare earths, and are they actually rare? Rare earths include 17 metallic elements in the periodic table made up of scandium, yttrium, and the lanthanides. The name rare earths is a bit of a misnomer, as the materials are found throughout the Earth's crust. They're more abundant than gold, but they are difficult and costly to extract and process, and are also environmentally damaging. What are rare earths used for? Rare earths are ubiquitous in everyday technologies, from smartphones to wind turbines to LED lights and flat-screen TVs. They're crucial for batteries in electric vehicles, as well as MRI scanners and cancer treatments. Rare earths are also essential for the US military. They're used in F-35 fighter jets, submarines, lasers, satellites, Tomahawk missiles, and more, according to a 2025 research note from CSIS. Where do rare earths come from? 61% of mined rare earth production comes from China, according to the International Energy Agency, and the country controls 92% of the global output in the processing stage. This isn't the first time Washington and Beijing have locked horns over tariffs. The 2018 to 2019 trade war, also under Trump, saw both nations impose billions in retaliatory tariffs, disrupting global markets and forcing multinational companies to rethink their supply chains. The difference now is timing. Both economies are facing serious internal challenges. China's growth has slowed sharply due to its property crisis and weak consumer spending, while the US is battling inflation and public debt concerns. A prolonged trade conflict could hurt both sides and, by extension, the global economy. A trade war of this magnitude would be disastrous for the global economy. The United States and China are not just the two largest economies in the world. They are the backbone of international trade, investment, and production. When either one falters, the effects are felt across continents. When both are in conflict, the consequences can shake the entire global system. Economists often say, when the American economy sneezes, the world catches a cold. It's a simple way of expressing how deeply connected the global economy is to the United States. Now imagine both America and China sneezing at the same time. The two biggest economies in the world. When the world's two largest economies collide, everyone feels the impact. The ripple effects go far beyond the US and China. Together, the two countries account for nearly 40% of global GDP. Any disruption in their trade relationships sends shockwaves through supply chains that touch every continent. Countries that depend on exports to either markets, such as Germany, South Korea, and Australia, could see demand fall. Meanwhile, developing economies that rely on Chinese manufacturing or US consumption may face higher import prices and weaker growth. Commodities are also feeling the pressure. Oil and metal prices dipped as traders priced in lower industrial demand, while safe haven assets like gold and the US dollar surged. Politically, Trump's announcement plays to his base. Many of his supporters see tariffs as a way to protect American jobs and reduce reliance on China. However, critics argue that such sweeping measures could hurt American consumers more than Chinese exporters. Economists have consistently noted that US importers and ultimately consumers bear most of the cost of tariffs. A 100% tariff would make a wide range of products more expensive, from electronics and clothing to cars and appliances. With the 2026 midterm elections on the horizon, the stakes are high. If inflation rises again and markets stay volatile, it could undermine confidence in the administration's handling of the economy. As of now, Beijing has condemned the 100% tariff announcement, calling it a violation of international trade norms. Chinese state media has urged calm, but warned that all necessary measures will be taken to safeguard national interests. Market analysts expect more turbulence in the coming days. When trading reopens, investors will be watching closely to see if China retaliates, and how fast. Any sign of escalation could lead to another round of sell-offs. Some optimists believe that Trump's announcement might be a high-stakes negotiation tactic aimed at forcing China back to the table for a new trade deal. If successful, markets could rebound quickly. But if both sides dig in, the result could be months of uncertainty and economic strain. The panic in the markets is not just about tariffs, it's about uncertainty. Businesses and investors thrive on predictability, and right now they have none. The US and China together power much of the world's trade, technology, and investment flows. A rupture between them doesn't just shake Wall Street, it shakes the world. For now, all eyes are on the coming weeks. Will diplomacy prevail, or will this spiral into a full-blown trade war? One thing is clear, the global economy is once again on edge. If you found this breakdown insightful, don't forget to like, comment, and subscribe for more fact-based news and analysis from Eureka.